It is a financial liability because it represents a contractual obligation. Please refer to page 3. We've covered the issue relating to group accounting, subsidiary, associate joint venture, accounting for joint arrangements, how to account for changes in parent interest in subsidiary, how to deal with foreign subsidiary and foreign associate, how do we deal with statement of cash flow for the group. The next important issue will be accounting for financial instruments. First, we'll look at AS32, financial instrument presentations, followed by FRS 9, financial instrument measurement. Please refer to page 510, an overview on financial instruments. Financial instrument is under HKFRS 9 and HKAS32. The first issue of financial instrument is we need to know what is financial instrument. We need to know the definitions of financial assets, financial liability, and equity instrument. To look at the definition of financial instrument, please refer to page 511. The definitions of financial instruments, financial assets, financial liability, and equity instruments. Financial instrument is a contract that gives rise to financial assets to one entity, financial liability or equity instrument to another entity. For financial instrument, it's any contract that between two parties. To one party is a financial asset, to the other party is a financial liability or equity instrument. Essentially, we need to know which party. For example, this is party A, this is party B. When we look at this contract, we need to know which party are we looking at. Are you party A or party B? In the exam, you have to study the question carefully. Financial instrument is a contract between two parties. To party A, it could be a financial assets. To party B, it could be a financial liability or equity instrument. Take for example, ordinary share. For ordinary share, to the investor is a financial assets. To the issuer, normally is considered as an equity instrument. However, there are some exceptions. For loans, bond, debenture, these are considered as fixed income instrument. To the investor, this is also considered as financial assets. But to the issuer, this is considered as a financial liability normally. For example, there's a sales or purchases on credit. To the supplier, trade receivable is a financial assets. To the customer, which is purchased on credits, is considered as a trade payable, is a financial liability. When we talk about financial instrument, it's a contract between two parties, A and B. When we talk about financial instrument, are we looking at party A or are we looking at party B? To decide whether it's a financial assets, financial liability, or equity instrument. For example, you have to study the question carefully. Like for example, ordinary share. Are we talking about investor or talking about issuer? Now look at the definitions of financial assets, financial liability, and equity instrument. Referring to your notes, financial assets, any assets, that's cash. I believe you know what is that. An equity instrument of another entity. Example, investment in share of HSBC. These are considered as an equity instrument of another entity. Or a contractual rights. Contractually, you have the rights to receive cash. Example, referring to item like trade or loan receivable. Trade and loan receivable, they represent a contractual right to receive cash. Or a contractual right to exchange financial assets or financial liability under conditions that are potentially favorable. These are referring to items like derivative assets. Derivative can be a derivative assets, it can be a derivative liability. It very much depending on whether the condition is it potentially unfavorable or potentially favorable. If it's a derivative instrument, it's potentially favorable, it's a financial assets. If it's a derivative instrument that's potentially unfavorable, it's a financial liability. Take for example, now is 1st March 2019. The company entered a contract to buy Australia dollar 10 mil and sell Hong Kong dollar 50 mil with settlement on 30th September 2019. This is considered as a forward currency contract. A forward currency contract, the nature is a derivative instruments. The settlement date is at 30th September 2019. A forward currency contract is an example of derivative instruments. The value of this contract will go up or down depending on the movement in the exchange rate. If the exchange rate is favoring the company would have a gain. If the exchange rate movement is against the company would incur a loss. The value of this type of contract up or down very much depending on the movement exchange rate. This type of contract, we call this as a derivative instrument. Maybe look at the definition of derivative instrument first. Refer to page 528. Derivatives. For example, as mentioned just now, like a forward currency contract is a derivative instruments, a call option or put options, the swap contract. These are examples of derivative instruments. Forward currency contract is an agreement between two parties to buy and sell something, like for example, a currency at a later date at a fixed price, agreed today. For derivative instrument to be within the scope of FRS 9, AS32, financial instruments, FRS 9 define derivative instrument as a financial instrument with all the three characteristics. In order for us to call a contract to be a derivative under FRS 9, first, the value of this contract changes in response with the underlying variable. The value of this contract will go up or down, subject to the changes in the foreign exchange rate. If the foreign exchange rate is favoring the company, the value will go up. If the foreign exchange rate is against the company, the value will come down. This is the first characteristics. The second characteristic is it required no initial investment, or even there's initial investment, the amount is considered as negligible. Take for example just now. When we enter the contract at the start, there's no payment involved. Basically, we just call the broker that we want to buy Australian dollar against Hong Kong dollar and settlement at the future dates. At the date we enter the contract, it does not involve any payment. Basically, we are just taking a positions to receive Australian dollar and to deliver Hong Kong dollar. And these settlements will be at future date. In order for us to call this as a derivative instrument under IFRS 9, we must have all these three characteristics. The reason company enter this type of transaction is for two reasons. One is for trading, the other one is for hedging. Like for example, if we think that Australian dollar is going to appreciate in the future, we buy Australian dollar now. When Australian dollar really appreciate in the future, we sell the Australian dollar, we make a gain. For that, we are doing trading for speculation purposes. We speculate on the movement of the exchange rate. But most companies will enter this type of transaction for hedging purposes. We'll discuss hedge accounting later on. This is just one of the many examples of derivative instruments, like for example, forward currency contract, swap contract, put option contract, call option contract. This type of contract have the three characteristics. First, the value of this contract changes with the underlying variable. Secondly is that when we enter in this contract, there's no payment involved. Even there's payment involved, the amount is considered as negligible. And third, settlement at future dates. We are taking a positions. These positions will result a gain or loss in the future. How do we account for this type of contract? In accordance to IFRS 9, all derivative instruments must be measured at fair value through P&L. Every year you must adjust to fair value, any gain or loss report in P&L, unless the entity apply hedge accounting. We'll discuss hedge accounting later on. Referring to the example that we have just now. Year end is 30th June 2019. We need to know what's the positions at the year end. If the position at the year end is favorable, then this will be considered as a financial asset. If the position is unfavorable, means we have to pay, this will be a financial liability. For example, for forward contract, the fair value at the start is 0, then we must adjust to the fair value at the year end. The fair value year end, take for example, the $2 million. If this position is favorable, then this will be financial assets. If this position is unfavorable, then this is a financial liability. The gain or loss, the plus and minus, from 0 to $2, this amount will be reported in P&L. These are some examples of derivative instruments, but derivative instruments do not just cover all these. In order for us to call this as derivative, it must have these three characteristics. Again, the value of the contract changes respond with the underlying variable. When you enter the contract, it requires no investment or the amount involved is negligible. And thirdly, settlement at future dates. Why do companies take out this type of contract? Is because for trading or for hedging. We'll come back to this again. Please refer to the definitions of financial assets, financial liability. Earlier on, we mentioned that financial assets is any assets that is cash, an equity instrument of another entity, a contractual rights to receive cash or another financial assets. Example is like trade or loan receivable, or a contractual rights to exchange financial assets, financial liability under condition that are potentially favorable. If it's potentially favorable, it's a financial asset. If it's potentially unfavorable, then it's a financial liability. Financial liability includes contractual obligations to deliver cash or another financial assets. Financial liability is the mirror effects of financial assets. That's why I put side by side. Financial liability includes contractual obligation to deliver cash. Example are trade or loan payable. Trade or loan receivable, these are trade or loan payable, depending on whether party A or party B. This is the definition of financial assets, financial liability. Equity instrument is a financial instrument that's not financial assets, it's an equity instrument. Or if the instrument is not a liability, then it's an equity instrument. Equity instrument is a financial instrument that is not financial assets, that's not financial liability, then it's an equity instrument. The definition of equity is any contract that evident a residual interest in assets of entity after deducting all the liability. At this moment, I think the definition of financial assets, financial liability are quite straightforward. However, when contract involves the settlement of the own equity instrument, then we have to be careful. This is the difficult, confusing parts. When there's a contract that involves the settlement of your own equity instrument, this contract, whether it's a financial assets or equity instrument, or whether this instrument is a financial liability or equity instruments, we have to look at the definitions. First thing, we look at financial assets, whether it's a financial assets or equity instrument. If it's a contract involve the settlement of your own equity instrument, then we have to consider all these factors. If a contract involves the settlement of own share or own share options, we have to ask ourselves whether this contract is derivative in nature or non-derivative in nature. Earlier on we discussed what's the meaning of derivative or non-derivative. Is the contract like forward contract, future contract, swap contract, option contract? If the answer is yes, then this is derivative in nature. Otherwise, it's a non-derivative in nature. If the contract that involves the settlement of your own share, which is non-derivative in nature, then we have to ask ourselves this question is that when the entity is required to receive the number of own equity instrument, whether this number of own equity instrument is a variable number or fixed number. If it's a variable number, then this is considered a financial asset. If it's not variable, if it's fixed number of share, it's considered an equity instrument. So when the contract involves the settlement of own equity instrument, which is non-derivative in nature, when the entity receives own number of equity instrument, is it variable number? If the answer is yes, then it's a financial asset. If the answer is no, then it's an equity instrument. If the contract is derivative in nature, it's like a future contract, forward contract, option contract, is derivative in nature. If the contract involves the settlement of own equity instrument, does this contract involve settlement other than fixed amount of cash for fixed number of shares? If it's other than fixed amount of cash for fixed number of shares, then it's a financial assets. If it's not other than, means it's for fixed amount of cash for fixed number of shares, then it's an equity instrument. Not financial assets, equity instrument. To understand this better, maybe you look at example. Please refer to page 512, example 1. Let's look at some of these separately. AB sell machines for $6,000. This sales of machine is a non-derivative contract. It's a normal business contract. The buyer will settle the purchase consideration by returning the ordinary share to AB for the purchase of machine equal to the value of $6,000 after a month. AB sell machines to the buyer. Buyer have to make settlement for this machine. Assume this machine, the carrying value is equal to maybe $5,000. AB need to credit machines because he sold the machine $5,000. And we sold the machine for $6,000, there will be a gain. This gain will be recognized in P&L, $1,000. Then you have to debit $6,000. The question is, what is this $6,000? You have the rights to take back own share. AB is going to take share from the buyer. If this settlement is in the form of the buyer share, definitely this is a financial asset. But this settlement is AB share. AB sell machine, in return taking back own share. We have to ask ourselves whether this own share that are taking back is a financial asset or an equity instrument. It very much depending on the number of shares that you're going to take it back. If the number of shares you're going to take it back is variable number of shares, then it's a financial asset. If the number of shares you're going to take it back is fixed number of shares, then it's an equity instrument. AB is going to take back share equals to the value of 6,000 after a month. After a month, if the share price is equals to $2, AB is going to take back 3,000 shares. If the share price after a month is equals to $5, AB is going to take back 1,200 shares. The number of shares is not fixed. So if the number of shares is not fixed, in this case, it's considered as a financial asset. Referring to the definition here. This contract involves the settlement of own share. And this contract is non-derivative in nature, for which AB is going to take back variable number of shares. So it's a financial asset. If AB is going to take back fixed number of shares, then it's not financial assets. If it's not financial assets, then it's an equity instrument. If the contract that involves the settlement of your own share is derivative in nature, then we have to consider, does that involve fixed amount of cash for fixed number of shares? If it's other than fixed for fixed, means not fixed for fixed, it's a financial asset. If it's fixed for fixed, then it's an equity instrument. Look at example. AB acquire a share options for $2,000 cash. Credit cash, $2,000. Debit options, $2,000. If this $2,000 is to buy someone's share, definitely this is a financial asset. This option is to buy back its own share. 10,000 share for $60,000 cash. If it's an option to buy someone's share, definitely it's a financial asset. But now, this option is to buy back own share. This option is derivative in nature because it has the characteristics of derivative instrument. When this contract is settled, does that involve fixed amount of cash for fixed number of share? Is it fixed for fixed? If the answer is yes, fixed amount of cash for fixed number of share, then this contract is considered as an equity instrument. If it's other than fixed for fixed, no or no, other than fixed for fixed, then this contract is considered as a financial asset. Again, when a contract involves the settlement of your own share, that is derivative in nature, or option contract is derivative in nature. When this contract is settled, is it involve fixed amount of cash for fixed number of shares? Is it fixed for fixed? If it's fixed for fixed, then this is an equity instrument. If it's other than fixed for fixed, then it's a financial asset. In this case, when AB exercises options, AB need to buy back 10,000 shares for $60,000 cash. So it's fixed amount of cash for fixed number of shares. Then this contract is an equity instrument. When a contract involves the settlement of own equity instrument, is it a non-derivative in nature or is a derivative in nature? If the contract involves the settlement of own equity instrument is non-derivative in nature, does this contract involve the settlement of variable number of shares? If yes, financial assets. If it's not variable, then it's an equity instrument. If the contract involves the settlement of your own equity instrument that is derivative in nature, when the contract is settled, is it for fixed amount of cash for fixed number of shares? Is it fixed for fixed? If it's fixed for fixed, then it's an equity instrument. If it's other than fixed for fixed, then it's a financial asset. If you understand the definition of financial assets that involve a contract that require the company to settle its own equity instrument, you should be able to understand whether the contract is a financial liability or equity instrument. Now we'll talk about financial liability. A financial liability is any liability that represents a contractual obligation to deliver cash, a contractual obligation that exchanges financial assets, financial liability under conditions that are potentially unfavorable. When the contract involves the settlement of own equity instrument, I purposely put side by side so they can see the difference. If it's a contract involves the settlement of your own equity instrument, again, we have to ask ourselves, is this contract derivative in nature or non-derivative in nature? If the contract that involves the settlement is non-derivative in nature, which require the entity to deliver variable number of own equity instrument, then this is considered as a financial liability. If the number of equity instrument is fixed number of equity instrument, then this is an equity instrument. If the contract that involves the settlement of the own equity instrument entity, which is derivative in nature, when this contract is settled, does that involve fixed amount of cash for fixed number of shares? If it's other than fixed for fixed, then this is a financial liability. If it's fixed for fixed, it's an equity instrument. We'll look at example, like what we did just now. AB issue an instrument for which received $5,000 cash. Debit cash, $5,000. Credit, whether this contract is a financial liability or an equity instrument for this $5,000. If I receive $5,000 with an obligation to pay cash, definitely this is a financial liability. The question says, AB will redeem the instrument after 2 years by issuing ordinary share AB to the value of $6,000. That means AB is not going to pay cash. AB is going to issue its own share. The settlement is to issue own share. If the settlement involves the issue of your own share, you have to be careful whether it's a financial liability or equity instrument. A contract involves the settlement of your own share. We have to ask ourselves whether this contract is directive or non-directive in nature. This is non-directive in nature because it's not an option contract, it's not a forward contract, it's not a future contract. These are non-directive in nature. It's just a normal contract which I issue a contract to receive $5,000 cash. After 2 years, I must settle this contract. Instead of paying cash, I have to issue my own share. The number of share I'm going to issue, is it variable or fixed number of share? If it's variable number of share, then it's considered as a financial liability. If it's fixed number of share, then we have to account this as an equity instrument. Question say, after 2 years, you issue ordinary share to the value of 6,000. It's not 6,000 shares, it's to the value of 6,000. Which means after 2 years, if the share price is $10, you have to issue 600 shares. After 2 years, if the share price equals to $2, they have to issue 3,000 shares. The number of shares to be issued is not fixed. For this question, it's a variable number of shares, it's a financial liability. It's important for us to know whether it's a financial assets, financial liability, or equity instrument for financial instrument accounting. Generally, financial assets, financial liability, equity instrument, initially, for example, if it's issued at $20, subsequently at the year end, if it's a financial assets, we need to adjust this to fair value or amortized cost. If it's a financial liability, same thing, we must adjust to fair value or amortized cost. If it's an equity instrument, we do not remeasure. Equity instrument, we never remeasure. But if it's a financial assets, financial liability, we must remeasure to fair value or amortized cost. The first step for financial instruments is to look at whether the instrument is a financial assets, financial liability, or equity instrument. We have to look at the definition. HKS 32 is dealing with presentation of financial instruments. For presentation, generally, there are 4 main issues that you need to take notes for examination purposes. First, for financial instrument issue, we need to know whether this financial instrument issue, is it a financial liability or whether it's an equity instrument. To answer this question, we have to consider the definition of financial liability and equity instrument. When I say definition, is the criteria. To differentiate whether it's a financial liability equity instrument, we must consider the substance of the contractual arrangement to decide whether it's a financial liability or whether it's an equity instrument. Substance of the contractual arrangement. Please refer to page 513. Financial instruments as a financial liability or an equity instrument. The classification of financial instrument as a financial liability or equity instrument is substantially based on the substance of the arrangement. In accordance to AS 32, a financial instrument is an equity instrument if and only if both of the following conditions are met. Please read out this criteria yourself. A. The instrument includes no contractual obligation to deliver cash. The financial instrument includes no contractual obligation to exchange financial assets, financial liability under conditions that are potentially unfavorable. If the instruments will or may be settled in the issuer-owned equity instruments, we have to consider the instrument whether it's a non-directive or directive to determine whether the financial instrument issue is a financial liability or equity instruments. Let me look at this in different perspectives. If I take away the no, if the financial instruments include a contractual obligations to deliver cash, or if the financial instrument include a contractual obligations to exchange financial assets or financial liability under conditions that are potentially unfavorable, this will be considered as a financial liability. This is the definition of financial liability. Financial liability is a contractual obligation to deliver cash, a contractual obligation to exchange financial assets, financial liability under conditions that are potentially unfavorable. These are the definition of financial liability. According to AS 32, a financial instrument is an equity instrument if and only if both of these conditions are met. When the instrument includes no contractual obligation to pay cash, no contractual obligation to exchange financial assets, financial liability under conditions that are potentially unfavorable. A financial instrument is an equity instrument if it's not a financial liability. If it's not a financial liability, then it's an equity instrument. First, to differentiate whether instrument is a liability equity, we look at whether it's liability. If it's a liability, it's liability. Otherwise, it's an equity. But we have looked at the substance of the contractual arrangement. Let's look at some example. Example 2, whether it's the instrument issue is a liability or equity. In accordance with AS 32, we have to consider the substance of the arrangements rather than the legal form. A financial instrument is an equity instrument only if it's not financial liability by looking at the 2 criteria. Applying that to this question. AB issued 10 million shares for $50,000 cash. If we stop here, normally we say share issue is an equity. debit cash 50,000, credit share 50,000, and this share, normally if the question is silent, we assume it's an equity instrument. However, the question mentioned that the holder of the share have the option to require the company to buy back the share for 60,000 after 3 years. If the investor requires the company to buy back the share, the company must buy back the share. The company cannot say no. The substance of the arrangement, the company do not have a rights not to pay cash in the future. If the investor want the money back, the company have to pay cash. In this case, we do not call this as equity instrument anymore. We call this as a financial liability. The legal form is a share, but in substance, the company could not avoid not paying cash if the investor required the redemption of share. Substance, this is a financial liability. Case C, AB issue a loan for $8,000 cash. If we stop here, we understand that this loan is a liability. Debit cash, 8,000. Credit a loan, 8,000. And we understand that this loan normally is considered as a financial liability. However, the loan will be converted into 40,000 share after 2 years. This is a contract involved the settlement of the equity instrument of the entity. We have to ask ourselves whether this contract is directive or non-directive. This contract is non-directive. If this contract is non-directive, when this contract is settled, does this involve a variable number of share? Answer is no. It does not involve variable number of share. It involves fixed number of share. So in this case, we do not call this as liability anymore. We call this as equity instrument. Because when this contract is settled, it involves fixed number of equity instrument of the entity. In substance, this is a prepayment of share of the company. The company receives $8,000 now, but the company is going to issue the 40,000 share after 2 years. It's a prepayment of share. If it's a prepayment of share, although the company have an obligation, but this obligation is not to pay cash. This obligation is to issue a fixed number of share. This is considered as equity instrument. It's not financial liability. If the obligation is to issue variable number of share, that is a financial liability. In account AS32, when we issue a financial instrument, whether this instrument is a liability or equity, we have to consider the criteria. The criteria, we have to fall back the definition of financial liability. Generally, we call this as equity instrument if it's not financial liability. We have to consider the substance of the arrangement rather than the legal form. Another very common topic for examination purposes, compound financial instrument. Compound financial instrument is any instrument that contains financial liability and equity instrument. If it's a contract involving liability and equity, do we show this as liability or do we show as equity? If we show as liability is wrong, if show equity is also wrong. It's a misrepresentation. We have to account separately. We have to split. So in this case, we must account for separately to represent the transaction faithfully. First, determine the financial liability. Whenever we talk about compound financial instrument, we must always first calculate the financial liability to be consistent with what we discussed. Equity is not financial liability. When you need to split between liability and equity, we must always calculate the liability first. And the balance is equals to equity instrument. How do you calculate liability? Normally for examination purposes, is the present value of the future cash payment. Please refer to page 514, compound financial instrument. Any instrument that contains both equity and liability. Example is convertible loan. Convertible loans is an example of compound financial instrument. But bear in mind, not all convertible loans are compound financial instrument. We have to look at the substance of the arrangement. In accordance to AS32, when the dealing with compound financial instrument means its liability come equity, we must account separately. For example, you have a contract of $60 million. If this contract of $60 million that contain liability and equity, this is considered as a compound financial instrument. If it's a compound financial instrument, we must account this contract separately. How do you split? You must always calculate the liability first, and the balance is your equity instrument. Liability normally is equals to the present value of the future cash payment. That means obligation to deliver cash. Take for example, is equals to 54. If liability is 54, total is equal to 60, then the balance will be equals to $6. That's how we account for compound financial instrument. Let's look at example 3. We look at case A and case B separately. AB issue loan for $500 cash at 5% per annum, payable in arrears for the first 5 years. This represents a contractual obligation to deliver cash. A contractual obligation to deliver cash, this represents financial liability. After 5 years, the loan will not be repaid. Instead, the loan will be converted into 800 shares after 6 years. The market interest rate for loan without conversions feature in this case is 7%. If it's a normal loan, the company has to pay 7% for 5 years, then the company must redeem back the loan at year 5. If it's a normal loan transactions. Because this is a special arrangement, they only pay 5% for 5 years. Based on 7%, the annuity factors for 5 years is 4.1. In this case, there are two components. The first component is the obligations to deliver cash. It represents a financial liability. The second component is the obligation to deliver fixed number of own share. It represents an equity instrument. We call this as a compound financial instrument. A compound financial instrument means any instrument that contains both. We have to account separately. We have to split. To understand this correctly, year 0, year 1, year 2, year 3, year 4, year 5, and year 6. At year 0, we need to debit cash. We receive $500. Credit financial liability because of obligation to deliver cash. We have to ask ourselves, what's the obligations? The obligation is the 5% of 500 for first 5 years. 5% of 500, every year we must pay 25, 25, 25, 25, and 25. What we need to do is that we have to discount this 25 to present value based on 7%. If we borrow externally, we pay interest of 7%. So we discount this 25 at 7% for 5 years. We can take 25 over 1.07, 1.07 to the power 2, 1.07 to the power 3, 1.07 to the power 4, 1.07 to the power 5. You add it out, it's equals to present value. However, we are given the annuity factors. So if you are given annuity factors, we just need to take 4.1 multiplied by 25. You have the same effect to calculate the present value, 103. This represents the present obligation to deliver cash. It's a financial liability. Then after that, we have to calculate this part. Equity is not liability. The balance, we have to credit a share rights reserve account. This 397 is the balance of 500 minus 103 equals to 397. This represents an equity instrument. We call this as compound financial instrument. An instrument contains liability and equity. Moving forwards, for equity, we do not adjust. After 1 year, equity will be equals to 397. Equity, we do not adjust. For liability, we must increase because of the 7% interest cost. The first year, our interest will be equal to 7.2. This is the interest expense to profit and loss. Then, we have to make the payment of 25 after first year. When it comes to year 1, liability will reduce to 85.2. That will be after the first year. The second year, again, equity will not be remeasured, 397. Liability after the second year, you have to account for interest again at 7%. 7% of 85.2, interest for second year is around 6. This 6 is the interest expense to profit and loss. Then we have to make the payment 25. After the second year, liability will be equals to 85.2 plus interest minus the payment will become 66.2. This is the liability portion after second year. We can do it for another 3 more years. Financial liability at year 5, this will become 0. In substance, the $25 we pay every year, we're paying for the 103 and the interest over the 5 years. That's the substance of the arrangement. This liability will pay off after 5 years. Equity after 5 years will remain at 397. When we issue share to investor, at the end of year 6, we have to debit share rights reserve, the 397. Then we have to credit the share capitals 397. This will be done at year 6. That's the entire cycle. The reason I go through this is because I want to demonstrate to you what's the meaning of substance of the contractual arrangement. In substance, when we issue this type of instrument, there are 2 components. One is financial liability, the other one is equity instrument. If it's a liability and equity, we have to account separately. We must always calculate liability first, the balance equity. After that, you have to think about the effect for subsequent year. We'll look at an example of compound financial instrument, which is more common in exam, convertible loan. Case B, we try to understand the substance of the contractual arrangement. We do not just look at the legal form. If you look at the legal form, loan means financial liability. But for financial reporting, we have to identify what's the substance of the contractual arrangement to decide what's the accounting treatments. For this question, the question mentioned that the company issue a loan for $600 cash. In return, what's our obligation? Contractually, the company have to pay 4% per annum. This 4% per annum, we call this as the coupon rate, means it's the interest that you have to pay every year. This amount is payable in the real. Normally that's the case. After 3 years, the loan will be redeemed, or the loan will be convertible into 300 shares anytime during the 3 years at the option of the investor. The market interest rate without the conversion rights is equals to 6% per annum. If we issue a normal loan without the conversion rights, we have to pay 6%. But because we issue a convertible loan now, we only pay 4%. For this question here, it's a compound financial instrument. There are 2 parts. You as the investor, I as the issuer. When you invest in my bond, what's your rights? Your rights is my obligation. You have the rights to receive cash 4% and take back the loan 600 if you decided not to convert. But you also have the rights to convert. You have rights to receive cash, you have rights to convert. From the issuer perspective, there's 2 obligations. The first obligation is the contractual obligations to deliver cash. The 4% every year, after 3 years, if it's not converted, I must pay back 600. This represents a financial liability. At the same time, I also have obligations to issue share if options is exercised, i.e. conversion rights. Conversion rights is as good as a share options. This is considered as an equity instrument. There are 2 portions. One is an obligation to deliver cash. It's a financial liability. The second part is an obligation to issue share if the options is exercised. We call this as conversion rights, or we call it a share option. In substance, this is an equity instrument. Let's look at this timeline. Year 0, year 1, year 2, and year 3. We start off by assuming that if it's a normal loan. If it's a normal loan, the interest will be paid at 6% per annum. If it's a normal loan, we account the loan as usual, debit cash 600 and credit loan liability 600. This loan liability represents the financial liability if it's a normal loan. We can check If it's a normal loan, the company have to pay 6% of 600 is 36, 36, 36, and redemption of the 600 loan after 3 years. If this loan is discounted based on the normal interest rate, the normal effective interest rate is 1.06, 1.06 to the power of 2, 1.06 to the power of 3. When we calculate the present value, it should be equals to 600. Now we look at a convertible loan. A convertible loan allowed the investor to convert the loan into share. In this case, it's at $600 for 300 share. It means that the investor have the rights to buy share at $2 each. The rights to buy share at $2 each represent a conversion rights, or you also represent a share options. If the share price is above $2, the investor would like to exercise the share because it's in the money. If the share price below $2, the investor do not want to convert and will get back their money. The conversion right, which is a share options, is an element incorporated in this instrument which allowed the investor to take advantage of any increase in share price. It's a right to buy share, but it's not free. In return, the investor must be willing to accept 4% interest per annum. Indirectly, the investor is paying for these rights to buy share by willing to accept a lower interest payment over the 3 years. Taking this 4% interest, every year the company only need to pay 24, 24, and 24. Again, if we discount this to present value, the liability will be equals to 568. This represents the present value of the liability component, which also equals to the fair value. The substance arrangement is that when we receive $600 from the investor, the $600 partly is receiving for the loan with an interest cost at the effective interest rate of 6% per annum. At the same time, we're receiving the $600 from the investor for payment of the rights to buy share. The rights to buy share is not free. We must account this as a share option separately as equity instrument at year 0. Accordingly, besides crediting a loan liability of 568, we also need to credit a conversion rights of the difference of 32. This 32 represents the difference between the 600 and the 568. This 32 represents the equity instrument. At the date of issue, initially, we must account the $600 separately as liability and equity instrument. When we receive $600 from investor, partly are receiving for an obligation to pay back cash of 24 with 600 after 3 years if it's not converted. At the same time, we are taking $32 from the investor for them to pay for the rights to buy share. We have to account this separately. One is financial liability, the other one is equity instrument, to reflect the substance of the arrangement for this $600. Thereafter, the conversion right as an equity, as mentioned just now, we do not remeasure, remain the same. But as a financial liability, the loan, every year we must remeasure to amortized cost. Every year we must make adjustment. First is for the interest. Interest cost effectively to the company, 6% of this 568. The first interest will be equals to 34. This 34 is an interest expense to profit and loss. Then after that, we have to make payment of 24. The 24 is the interest based on the coupon rate, which every year we must pay. We only pay 24 to the investor, but our interest cost is 34. The $10 represents interest expense, which we do not need to pay the investor because we withhold the $10 for them to pay for the rights to buy share. After 1 year, liability will remeasure to 578. This 578 as a financial liability will be measured at amortized cost. When it comes to second year, we'll do the same. We must account for interest based on 6% again. When we go out and get a loan, effectively we have to pay interest of 6%. The 4% interest is an interest based on the rights to convert. Without the rights to convert, the company should be paying 6%. 6% of 578, the second year interest will be equals to 35. This 35 is an interest expense to P&L. But amount interest paid, 24. Yet our interest cost is 35. The $11 is our interest cost, but we are not paying the investor because we withhold for them to pay for the rights to buy share. After the second year, loan liability will be equals to 568 plus 35 minus 24. So that gives us 589. This is financial liability at the end of second year. Now look at the final year. Final year we must account $35. This $35 is interest expense based on 6% effective interest rate. But contractually, we're only paying the 4% because in return, we allowed the investor to buy share at a fixed price. Investor have to pay for it. At the end of the third year, liability will come back to the amount of 600. This 600 is the amount for redemption. This entire process. For equity instrument, we do not remeasure. Every year is the same. But for financial liability, normally every year, we must adjust to the amortized cost. We'll discuss this in detail later on. When it comes to the end of the third year, the last time that the investor decide whether they want to convert or not. Now we talk about this. If you refer to the statement of financial positions at year 3, under the equity, the company have share capitals of X dollar, retained earning of X dollar as well. And under the equity, there's this called conversions rights reserve, which is equals to 32. And there's a liability of loan, which is equals to 600. At the end of year 3, the first scenario is no conversion. If it's no conversion, means it's a cash settlement. We have to debit loan, 600, and credit cash, 600. The second scenario is conversion into share. We call this as share settlement. Debit loan, 600, and credit share capital, 600. At the end of year 3, one scenario is no conversion, settle in cash. The second scenario is conversion into share. What happened to these conversion rights? When this loan is converted into share, we may transfer to share capitals. In accordance to AS32, there's no difference. Whether you're going to put under conversion rights or whether you're going to put under share capitals, we're still under equity. Equity still belongs to shareholders, so there's no difference. But if it's settled in cash, conversion right will stay under conversion right as part of equity. No adjustments required. But if this is converted into share, as mentioned just now, we may transfer the 32 to share capitals. In the context of the shareholders, it's still under the equity. Whether you're going to put under conversion rights or whether you're going to put under share capitals will still be under your equity. For AS32, presentation of financial instruments, the second issue just now discussed is compound financial instrument. The third issue, where do we present the cost? Should the cost on financial instrument be presented in profit and loss? If the financial instrument is a financial liability, then the cost will go to P&L. Like for example, interest on loan. Interest on loans is in P&L. If the financial instrument is an equity instrument, then the cost will not be in P&L. The cost will be in statement of changes in equity. Take for example, dividend paid for ordinary share. Dividend is not an expense. Dividend is considered as distribution earning. So the dividend will be shown in your statement of changes in equity. It will not be shown in P&L. If the financial instrument is an equity instrument, then the cost will not go to P&L. The cost will go to statement of changes in equity. If the financial instrument is a financial liability, then the cost will be shown as an expense to P&L. The last issue for presentation of financial instrument is, do we offset financial assets and financial liability in balance sheet? Do we present these two separately or do we present these two on a net basis? In accordance to AS32, financial assets, financial liability should be shown separately unless the criteria are met. Referring to your notes. Refer to page 516. Do we offset financial assets and financial liability in the balance sheet? In accordance to AS1, assets and liability should be shown separately unless another standard require or allow the offset. In accordance to AS32, financial assets, financial liability should be shown separately unless the following criteria are met. When the criteria are met, then we have to show it on that basis. For example, we have a trade receivable from AB company is equals to $50. We have a trade payable to AB company for $48. AB is our customer, AB is also our supplier. There's a receivable and payable from AB and to AB. The question is that, do we show these two receivable and payable separately, present separately, or do we present these two on net basis? In accordance to AS1 and AS32, we have to show these two separately. Assets and liability should not be offset. In accordance to AS32, trade receivable is a financial assets, trade payable is a financial liability. Financial assets, financial liability we show separately. Both financial assets, financial liability have different credit risks and different cash flow risks. But under what circumstances we show on net basis? We only show the financial assets, financial liability on net basis if we meet the criteria. This criteria is under HKAS 32. In accordance to AS32, we should show on net basis only when there's a legal enforceable rights to offset. When there's come to settlement upon liquidation of the company, we have the right to offset the financial assets, financial liability. This is one of the conditions, it's a must. But this condition alone is not good enough, and we must have intention to settle on that basis or intention to realize assets, settle liability simultaneously. All the while, we have arrangement with company AB. If they owe us 50, we owe them 48 at the year end or month end, we'll settle the difference of $2. We have this kind of arrangement to settle on that basis, then we show the receivable and payable on that basis. Otherwise, we must show it separately. For AS32, there are 4 issues. Whether the instrument issue is a liability or equity, depending on the definitions of financial liability. If it's not a financial liability, then we call that instrument as an equity instrument. The second issue, which is most important among these 4, is compound financial instrument. Compound financial instrument means any instrument that's liability and equity. Then we must account separately. How do we account separately? We must calculate liability first, then balance equity. The third is, how do we present the cost of financial instrument? If the financial instrument is a financial liability, then the service cost will be part of P&L. If the financial instrument is an equity instrument, then the service cost like dividend or ordinary share will be part of statement of changes in equity. Lastly, do we offset financial assets, financial liability? Generally, the principle is no, we do not offset unless the criteria are met. Please refer to page 551, question 20.9, a Module A questions. This question is to discuss how to differentiate a financial instrument issue, whether it's a financial liability or an equity instrument. Study the questions, understand the issue. We're going to discuss this question shortly. Determine how the entity should account for the financial instrument to be issued. 10 marks. For 10 marks, there are two parts, A and part B. Each part is around 5 marks. Your answer should be around 5 to 6